Hello, everyone, and welcome to our webinar, What Motivates a Bank to Lend You Money Today? My name is Andrea Frost, and I'll be your moderator. I work on the communications team here at the Capital Masters, and I'm excited to be hosting this session. We've got two incredible panelists coming up. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. For the past several weeks, he's tapped into his extensive network of bankers nationwide to develop an insider's picture of today's lending climate. Rich Russakoff is an international speaker and experienced business coach skilled in creating the dynamic narrative and top-notch business plan that banks need to say yes. Together, this top-notch team is going to reveal and explain what lenders are looking for when it comes to granting a request for capital during this disrupted economy. Before I hand the mic over to our two experts, though, I do have a couple of housekeeping items to cover. First, today's webinar is being recorded and will be available on demand after the live session. Once the webinar is concluded, we'll email you a link so that you can access the recording. Also, we would love to hear from you during today's presentation. If you have a question for our speakers, please feel free to send it through the Q&A tab at the bottom of your viewing window. We'll save the questions for the end of the session, and if we don't get to yours during today's webinar, we'll be sure to follow up afterward. So without further ado, I'd like to kick things off. Rich and Bob, over to you.
Thank you, Andrea. And let's bring up our first slide, and let's move to the actual first slide here. So Bob, in the work we've been doing right now, we're working on 5 different loan packages, and in virtually every case, the ideal solution today, in today's times, is an SBA 7A loan. Please share with us why this is such an invaluable lending vehicle for both banks as well as for those looking for loans, and why SBA is such a vital force in providing capital at this time in the marketplace.
Thanks a lot for that question, Rich. Yes, the SBA was created initially to allow banks to do loans they would not normally do in the course of their daily business. In the old days, banks would lend to existing businesses, they wouldn't lend to startups, and they'd lend from, say, 3 to 5 years as commercial banks. The SBA allows them to mitigate the risk of taking on startups or maybe what's considered a more risky transaction than somebody who's been in business 3, 5, 10 years by giving a guarantee to that bank in the event of default. They can recoup anywhere from 50 to 75 to 85, in some cases 90% of their loss, providing all I's are dotted and T's are crossed.
So before we continue, Bob, in the what this really means for the bank is if they're getting a guarantee of 50 to 75 or 80%, with the exception of fees that go to SBA, in the beginning, the bank gets the benefits of the loan and the interest with minimal risk based upon the nature of the loan and the guarantee SBA offers.
Yeah, that's correct. The down payment coupled with the SBA guarantee significantly lowers the risk of the bank.
So let's talk about what's in it for the bank other than that.
For the bank, if it's a bank that portfolios or keeps its loans, then that's an income generator for the bank. They make interest income off of the loan. For banks, and many of them do this, who do not portfolio the loans but service them, meaning they sell the loans on this what's called the secondary market, the banks will earn a premium on that loan that allows them to pay for services, for labor, rent, operational expenses. So it's kind of a win-win for the bank to do these loans, also with the lower risk.
That's how I was able to acquire my first loan, was an SBA loan. Without it, no bank would have touched me. And that leads to the question of, what do I need if I think SBA is the best path ultimately to guarantee the loan and go for an SBA 7A loan? What do I need to know to be ready for it? Because there are a lot of regulatory requirements, and ultimately we need to give that to the bank. And the more we know going in, the more we can give the bank, the quicker the transaction and the more savvy the bank will see us.
Yeah, think of it as going for a job interview, in that whenever you go for that interview, you do research on the company that you're interviewing with. You, of course, have your resume, which in the bank's case would be your business plan, and you research what the requirements are for that specific program. So do your homework, research, and find out all you can about the bank that you're going to be requesting a loan from, even the staff, if you can get to that granular level. Research the SBA and its programs, because one thing I've learned that a credit officer once told me was that blue sky does not repay debt. The bank doesn't get paid on blue sky, meaning that ideas, pretty pictures, they don't repay debt. Cash flow does.
Bob, when I went for my first SBA loan, I contacted SBA. I was in Nags Head, North Carolina, and I think the office was in Greenville. And what the loan officer said to me, the person from SBA said to me is, please just fill out all the forms. Most people that go for this independently, he said, drop out because of fatigue of doing the work that needs to be done. And I made the decision, not only was I going to give them everything they asked for, but more. So what I'd like you to explain a little bit is, what are the regulatory requirements? And I don't want you to go through a laundry list, but some of the key things that are going to be important that the bank needs to pass on to SBA through the information that someone looking for the loan puts together.
Yeah, that's a great question. And some of these might be mundane, but nonetheless important. The SBA is going to be looking at your citizenship status. There's a lot of people here with green cards, which is okay, but there's some that are not, like E2 visas, investment visas. Those are no longer allowed. There's in some of the SBA loans, like 504s, there's a requirement per every $1,000 or $10,000 to have a certain amount of people employed. There could be a Community Reinvestment Act stipulations within the deal. So they're going to look at federal regulations that allow them to take advantage of that guarantee and to really be fostering small business that couldn't get done anywhere else.
Thank you, Bob. One other point on this, one of the clients we're working with right now does business internationally, and that opens the door for an SBA export-import program, which I think one of the banks reached out to you and said to you, Bob, if you can find me one of these, we'd be real interested. Would you explain why, what's in it for the bank, what's in it for SBA, and how, if you're in that situation, you might be in a very good spot for an SBA loan?
Yeah, the main thing there is the bank can get a 95% guarantee. That means 95% of their risk is essentially mitigated, providing the deal doesn't go south. That's a big, and I'll use the word mitigant for a bank. And for the SBA, they're fostering international trade with a domestic company.
So basically, if I have a company in the States and I'm importing, if I'm exporting a product or service, I may well qualify for this?
That's a possibility, yes. It would require underwriting, of course, but yes.
So that's all the more reason to know the rules of the game so that you can make them work for you. Let's take a look at the next slide. So Bob, is there anything here we missed on the last slide that you think we should address?
Well, when we're saying the borrower needs to give the bank everything they need, and you gave your example of filling out every document that the bank wanted it in that epoch, what we're talking about here really is don't hold back on anything. Yes, you're going to have a loan application. Yes, you're going to need a business plan. Yes, you're going to need to articulate and explain where your numbers came from. You really need to give the bank anything and everything they ask for as they ask for it. I wouldn't be arguing with them or saying, why do I need this? Why do I need that? Just give it to them. And if you're not sure why, or not why, but not sure how to do it, then, reach out to your CPA, your accountant, to us, or to the banker to get an elaboration on it. But it's really important. Yeah, it's really important because the way you submit your deal to the bank is a direct reflection on how they consider you run your business.
Absolutely. I like to say your spirit shows in everything you do, and that will impress the bank, even with the smallest details. Bob, let's take a look at bullet number 3 to ensure they get repaid through the SBA guarantee. What are the concerns a bank might have there, and why might this not be a slam dunk that if I go south, the bank, the guarantee kicks in for the bank?
Yeah, the bank's primary duty, other than making loans and making money for its entity, because they're not nonprofit charitable entities, is protecting the government guarantee. Once the guarantee's gone, they're unable to participate in the SBA program, or they're going to be hamstrung. So it's paramount that they protect that guarantee. To do that, all of the documentation required, not only from the borrower, but from the bank to the SBA, needs to be, perfect, pretty much. I mean, everything has to be submitted that's required. There are underwriting concerns that have to be followed. I mean, the SBA SOP, it's a 1,200-page document. There's a lot of stuff in there that has to be executed properly. But at the base level, was this underwritten properly? Were the guarantors adequately underwritten? Was the cash flow adequately underwritten? Did you underwrite and approve a loan that really shouldn't have been approved? That if they do go bankrupt, or the economy changes and they go south, or there's road construction and the deal cradles, is the guarantee going to still hold up?
So that kind of reminds me of an insurance claim. Okay, I've had the fire, now you're going to pay me the money, and then the adjuster looks at it and says, you didn't dot this I or cross this T. So it's critically important for the bank to give the SBA everything they need in the event that I default. And so when the bank asks you for things, you need to look at it from their perspective and understand that by protecting themselves, they're also giving the bank what they require, the SBA what they require.
Correct. Also, the golden rule is attributable here. He who has the gold makes the rules.
Thanks, Bob. Let's move on to the next slide. Bob, this term historical trends and minimum 3 years, what are we talking about here? Are we talking, and below we're talking about cash flow. what do you mean? What should it mean to me when I see positive historical trends?
Yeah, as part of underwriting a loan or, any business situation, you're going to look past history generally dictates future results. So mathematically, to make a trend, you need to have at least 3 data points. In this case, 3 years of tax returns. It's a government guaranteed loan, so the underwriters are going to look at government documents. Well, what's a government document? Your federal tax return. So they're going to go back 3 years and they're going to see, okay, has the top line sales of this company been stable? Is it on a roller coaster or is it going up? Are the cost of goods sold fairly consistent? Do they fluctuate or are they, increasing or decreasing? Same thing with SG&A. And then what really pays back the bank at the end of the day is cash flow, which is we call it EBITDA, but it's net income adding back non-cash items. Is that adequate to cover the amount of the loan that you're requesting at a given interest rate?
And Bob, when you do your crunching of numbers to determine whether the ask is realistic, that ratio you were just talking about of cash flow necessary to give the bank the comfort that you can afford to pay it back, would you share a little bit about what that ratio looks like so I can do the math and know whether I need to make some adjustments?
Yeah, I mean, it's very simple. It's earnings before interest, taxes, depreciation, and amortization. In accounting, it's EBITDA. It's the cash flow number over the principal and interest proposed of the loan. And what banks are looking at historically for SBA, not for conventional loans, but SBA, is that ratio is greater than 1.25 times.
And how about for a conventional loan, Bob?
Well, conventional loan, it depends on the bank and the facility, but generally, real quick, the difference between SBA and conventional underwriting, SBA underwriting is based on the cash flow of the business. Conventional underwriting is based on the cash flow of the business plus the strength of the guarantor and their personal cash flow. So it's a whole different methodology. And generally, you're looking at 2.0 times or greater, extremely stringent. So that's another reason SBA is such a good deal for small business owners. And small business, meaning, businesses less than, 10 million, $20 million a year.
Which is most businesses.
Yeah.
And Bob, I don't recall the number off the top of my head, but I believe about 50% of small business loans have an SBA component. What was your experience, and do you think that's still the rule?
Yeah, I don't know what the exact metric is these days, but given what we're going through, if you have a business that's viable, that's still operating, and the way you got affected by COVID didn't actually shut you down, but just put you at a less advantageous position, SBA is still the best route.
So I want to make a point here where we say sales, cost of goods, SG&A, cash flow. We are working on a loan for a client, and in 2018, their top line was about $400,000 more than in 2019. However, in 2019, their profits were much greater. Why? Because they eliminated clients where there was low margin. So what you need to do in your package when you show historical information is be able to say, yes, we made a decision that made us more efficient, enabled our infrastructure to handle the best possible deals, to start marketing for them. And as a result, we brought more money to the bottom line. And as we were going into the next year, we were marketing to where our sweet spot was. And I think that's critically important to explain this so the bank understands you made a smart decision and why. Anything you want to add to that, Bob?
Yeah, the key thing is know your numbers, know your operations, and be able to articulate it when a question's asked by the credit officer.
So the last thing you want to do is go in there with a bunch of financial statements that you got from the accountant and make a presentation and not have a clue why there are variations in sales, cost of goods, and SG&A. And if you can't do that, it's a red flag to the bank. And Bob, from your perspective, share the obvious. Why is that a red flag?
I mean, a stack of paper doesn't make a loan package, and not knowing your numbers and not being able to articulate them, even your projections, not having a business plan, that's not going to give any comfort to a banker whatsoever. That's, like we said earlier, direct reflection on how you run your business, and it doesn't look like you're running it too well.
Thanks, Bob. Let's move on to the next slide. What do we mean by sufficient historical cash flow? And before you say that, I want to say what I like to tell business owners is that banks look at historical. Investors look at the future. Investors couldn't care less about the past if they see that the future looks great. For bankers, if your past doesn't look good and you start saying, oh yeah, but here's where I'm going, it's a total reversal of how it's perceived. Did I leave you without a thought there, Bob?
Yeah, I was enjoying what you were saying there. Sufficient historical cash flow, we touched on it in the previous slide. You're going to historical trends. The banks are going to be looking backwards at that debt to EBITDA ratio to see if in previous years the future debt would have been covered by the cash generated by the business.
And if you can show that, you're in very good shape. And even, for example, now, if you went through a downturn because of the pandemic or are still going through the downturn, but you can show historically 2019, 2018, and that you could cash flow, and you are now beginning to get your cash flow back to the levels of the past, that can more than mitigate the pandemic effects, because we've all had to deal with that.
Correct.
Okay, next slide, please. When I do packages historically, and they're with companies that are service businesses, for example, they create and sell software, and I get to the management and ownership section, I know our greatest asset is people, and the importance of the people, the quality of the team, as we're saying here, the experience of the team. And even though you can't collateralize that, that gives the bank enormous comfort. And even from the standpoint of a bank may look at you and say, okay, is this guy a marketer? And that means he tells a good story. Is he or she an inventor and they're focusing on specific financial stuff, but they don't have that marketing perspective? Are they a salesperson? Who is in front of me, and who do they have on their team to complement them, and what's their experience? So Bob, what do you want to see when you're looking at a package from the standpoint of the bank and you're assessing the team?
Yeah, I mean, management experience is going to be one of the top items that we're looking at. There are certain industries that if it's not there, it's going to you kill the deal on the front end. But for existing businesses, the rule of thumb is at least 3 to 5 years direct industry experience within that niche. And the strength of the management is a strong mitigant to knowing that if there's a downturn or if there's a hiccup, that they know how to correct, pivot, and keep the business afloat.
So one of the things I'd be looking for is if I'm the visionary, if I'm the CEO, do I have an operations or general manager that makes the trains run? Do I have a strong financial person that can give us real-time financial information to make good decisions? And are we collecting our accounts receivable on time? Do I have a solid sales and marketing arm to enable me to make the sales and marketing that's necessary? Am I covering all the key positions? And in many cases, you may not be able to afford a CFO or a marketing expert, but you have a marketing team, and there's a new term these days called fractional, where you have someone that is your fractional CFO or your fractional marketing person or a fractional operations expert that enables the company for a limited amount of dollars to have top-notch talent. Any thoughts you want to make, particularly on the financial side, Bob?
Yeah, there's a lot of businesses and entrepreneurs out there who are great at selling. They're great at creating software. They're great at promoting their products, but they really don't have a feel for the financial end of things. And for example, a fractional treasury officer that comes in and works with the business to optimize how much is in cash, how much is in debt, what do they look like to a bank, what are their probabilities of obtaining financing, do they need financing, you know, what do their metrics look like compared to other companies? That can really be a benefit now and going forward. Because times are changing, and you need to get a jump on where you are now and where you need to be next year.
So one of the things our leadership team has identified that you, Bob, really have the expertise and the skills to be a fractional treasury officer. And I don't think most entrepreneurs even know what that is. So if you're interested in learning more about what Bob just said, ask it in a question, or we can talk about it later, because the importance of a treasury officer sets up the foundation and helps you make the right decisions on a financial basis for growth. Let's move on to the next slide. Bob, I want you to jump in on this one and explain what we're talking about here with the guarantor and the liquidity and reserves. And we're going to do a whole program on this, if not a course, but give us an elevator piece on each one of these. What we mean by guarantor here specifically, and sufficient liquidity and reserves.
Yeah, thanks. Generally, the guarantor is the principal owner of the company, or whoever owns 20% or greater of the business, and they're going to be responsible for signing the loan documents and responsible in the event of the loan going into default, and having the responsibility for repayment of debt to the bank. Liquidity is how much money they have in the bank, in either them or the company or both, in order to make the down payment Liquidity is not collateral. It is money in the bank, and or any facility that can be converted to cash in 90 days or less. Reserves are just what they are. That's your savings account. And in a bank, that can be, or in a business, that can be money you have sitting around in CDs, treasuries, or in the actual commercial savings account. And the banks are going to look at certain metrics to determine, can you make, for example, for an SBA loan, a 20% down payment? And on top of that, do you and the business have at least 10% more sitting around in cash to the entire project amount as reserves? Or you can think of that maybe being 6 to 12 months of reserves sitting in the bank. And right now during COVID, that's something I'm hearing more and more from credit officers across the U.S.
Yeah, I know you've been talking to credit officers almost on a daily basis. And anything you want to share about the pulse of the market right now?
It's there's plenty of cash out there to lend. However, to access that cash, you're really having to present a top-notch loan package that is factually based, that is addressing COVID-19, and that articulates what the real strengths are to entice a bank to lend money in this world. And on top of that, the SBA is kind of tightening down on some of their cash flow requirements for performance, even during COVID-19.
So the good news is, as an entrepreneur, when they say, is the glass half full or is it half empty? The entrepreneur says underutilized. So when I hear there's plenty of cash out there, I say, hey, it's underutilized. How do I get that money? How come the banks are in a situation where they have cash to loan if they feel it's a good risk for them?
Yeah, I mean, I was talking to a senior vice president just about an hour and a half ago, and they're still looking for good loans. And the challenge is, however, what is a good loan since March? A lot of companies who were doing really well last year and through the first of this year are in the tank now. How do you underwrite that? And that's really the question. So it's going to be paramount that you find a lender who is sympathetic to your situation and one that really wishes to partner with you. It's kind of like, fit to going into that interview, and the interviewer knowing within the first minute whether they're going to hire you or not.
So there again, we're back to how do we position ourselves and who is the right person to find the right bank. And all banks are not created equal. And at any given time, a bank that was not aggressive a year ago could be aggressive today. So don't assume from what one bank says is the gospel. And that's why I think it's important for you to talk to your peers, find out who's lending, who's aggressive right now, get a referral, but none of that matters if you don't meet the qualifications.
And there's no, this is what the SBA does, and that's the gospel. There is none of that. Every bank that I've ever dealt with handles the instruction manual, standard operating procedure of the SBA differently. Although maybe 80% of what they do is out of the SOP. Some lenders won't do franchise deals. Some lenders only do real estate. Some lenders won't touch startups. But all that's allowed in the SBA. So you really have to know your bank. You really have to know your lender.
And the first thing we do when we go shopping for a bank is we get the loan officer on the phone. We say, we're representing a client. This is their business. This is their historical record. This is how they've handled the virus. This is where we will believe we believe we will be in 2021 and 2022. We have an extensive package. Would this be a loan you'd be interested in considering? There's no bad answer, because if they say no, move on to somebody else. If they say no, and ask them who would be interested, because Bob, I'm sure you can share, every bank knows what the other banks are doing.
Right. Some of my best deals have come from referrals from banks who've said no.
And if they say yes, consider them and make an appointment, but do your homework and be ready before you see them. Let's move on to the next slide. Now we're into this collateral issue, and we're talking a little bit about mitigants. So Bob, let's talk about what a mitigant means, why it's important, and let's clearly, again, identify what collateral truly is.
Yeah, at the end of the day, after all the analysis has been done, all of the number crunching, looking at the management, looking at the industry, doing everything you need to do in underwriting, the question comes down to, do the strengths of this deal outweigh the weaknesses? I mean, that's really what it comes down to. Strengths can be, credit standing, management experience, cash flow coverage, amount of collateral. Do the strengths outweigh what's weak in this deal? If they do, then you move to approve the deal. A mitigant is an offset to a weakness, basically. If you only have 50% of collateral for a loan, but you're able to put down an extra 10% in down payment, that might be an offset. That might be a mitigant to not having as much collateral because you've lowered the basis of the loan. And collateral is hard assets, hard real estate, commercial or residential. And the SBA has an all available collateral rule, meaning they're going to go after all available collateral until they've exhausted everything that's there. So even though you own a home, you maybe have a second mortgage on it, or you have a lot of equity in it, the SBA is going to attach it if it makes sense to the amount of the loan. Equipment, heavy machinery, what they call yellow machinery, trucks, tractors, trailers, not so much forks, knives, and spoons in a restaurant. But go ahead, Rich.
No, I was just laughing at what you said. Please continue.
Yeah, because forks, knives, and spoons in a liquidation or a foreclosure get you 5 or 10 cents on a dollar. Yellow machinery will get you 50 cents on the dollar. Your home, 85 cents on the dollar. Your commercial building, 80 cents on the dollar. There's values assessed to all collateral, but it has to be hard, tangible collateral. Accounts receivable, inventory, that's not really collateral. Somebody's going to give you money down the road, that's not collateral. We had a funny story about that, but just know that it has to be hard assets. Collateral is not equity. Equity is not necessarily liquidity. They're all different concepts.
Bob, I think it was somewhere around 2004. I worked with a gentleman who's allowed me to share this by the name of Daniel Marcos, that many people in the entrepreneur organization know. And Daniel had started a business where he was buying homes and then renting those homes to immigrants with the idea that they could buy the home after a year of showing that they could pay rent. And we were able to convince the banks on this startup that we had the mitigants to make them comfortable. One was our normal cash flow. Two was escrow from defaulted, because on every deal we did on the home, we received escrow that went into account that the bank could touch if needed. Reserve accounts, out of every $100 that came in, 15 went into a reserve account that the bank could have. That's money. 4, the equity in the home 5 personal guarantees by the business owner. So it wasn't just one thing, it was all the things that gave the bank the comfort level. And it was real estate, of course.
Yeah,
So,
yeah.
go ahead, Bob.
No, those are great examples. And regarding a guarantee on the loan, that will always be required on an SBA loan. There's no negotiating it. There's no partial guarantees. It's going to be a full 100% guarantee by any owner who owns 20% or greater of the business.
And that's the important thing. I know I've advised a lot of people that invest in businesses. It's better to own 19% than 21 for exactly that reason.
However, there is a what I call the hotel rule that comes into play, that even if you're doing 19 and the credit officer thinks you're trying to skirt the 20, they might require you to be a full guarantor.
Well, then I would have my lawyer talk to them or go to another bank. Let's go to the next slide. We're slowly reaching the point where we're going to be taking questions. So this one here is near and dear to my heart. And when Bob and I started working together, I think one of the things that convinced Bob that the approach I was taking was the quality of the business plans we put together and how that would impact the loan officer feeling, I get it, I want to sell it, and I think I can convince the credit department to say yes. From your perspective, it seems like every banker you're talking to says, I need to see the written plan with the assumptions that go with it, because without assumptions that are credible, it's pie in the sky. What are you hearing, Bob?
Yeah, the thing I'm hearing from credit officers right now is that the business plan really needs to be strong. It needs to be fact-based, have valid assumptions, address all the normal things a business plan addresses, from SWOT analysis to competition, but more importantly, how has COVID affected the business from March to now, and what does it look like to the end of the year? And then, you know, your assumptions for all of the variables in the proposed profit and loss projections going forward. Can you articulate those? Do you have valid backup to those, demographic reports, things like that that can substantiate all the numbers you put in there?
So you're strutting your stuff. And that's why milestones, which show your history, which shows key events, awards you've won, bringing in great talent, adding another profit center, getting great clients along the way, simple milestone with bullets in them, tell a great story. And when we started working together, Bob came to us and said, there's a software program, a company called IBIS. And what IBIS does is gives the banks the industry information they need to make an assessment on where the industry is going. So we bought it, and we include IBIS in all our packages, IBIS information. Let's talk about, for a minute, Bob, the importance of an industry section to the bank and to you to know your trends.
Yeah, the importance of the IBIS report is that it will address everything at a macro and even to a micro level in some industries, all of the trends that are going on within that NAISC code, that industrial classification code. And it will address who the suppliers are, who the users are, what is happening right now during COVID, what is happening internationally, what is happening locally. It'll go into just almost every kind of metric you can think of, in addition to many of the RMA risk management association ratios for a given industry at different asset and sales levels.
So why does the bank care about the industry? Not me, just me.
Yeah, I mean, they care a lot because, you know, how are you performing in relation to your peers? Are you at the mean? Are you to the right of the standard deviation? You to the left? You know, it's very important to understand, is this an industry that we even want to lend in as a bank?
Mm-hmm.
You know, and how are you performing in relation to that?
We're working with a restaurant, and it's 2 franchises, and they're about to expand into the Houston market. And they own about 11 other restaurants. I may be off by 1 or 2, but we're able to show that in the area they focus, which is a little bit of, which is comfort food at a higher level, and also craft beers, they are outperforming the industry. And we have the data to show that, and the ability to show that we're past break even now with the virus, and we're on the top curve of the industry is really going to be powerful when we go to the bank.
Yeah, I believe that business is operating 5% over there, what they were doing last year. It's amazing.
So being able to say that, it's how do you sell the sizzle? How do you strut your stuff? What's important, and be able to document it, not just pie in the sky, not just saying, my gut is we're way ahead of everybody else. That doesn't fly if you're trying to sell Bob that with his banking hat on.
Right.
So let's take a look at the next slide. I think we're very close to asking questions. What questions do we have, Andrea?
We do have a couple of questions. One of them is, what are some of the biggest mistakes that people make when they go to approach or talk to a bank?
Well, I'll start it from my side. Not doing your homework, not being prepared, not giving them a comprehensive plan, and not knowing your numbers, and not identifying your red flags so that you can tell them, yeah, we have this red flag, here's why, and here's what we're doing, and how it's making a difference. And I'll give you an example. Years ago in Richmond, I was working with a natural food store. It was just at the beginning of the natural foods world, and a huge natural food store was coming into the market. So the red flag might be, they're going to take your business. How are you going to compete with them? And what we said to the bank is, look who's coming in. They spend on an average of X amount of dollars promoting natural foods, and we're going to be able to leverage that, and the market will expand. So it's how you take the red flag, you point it out, and you point out how you're going to deal with it. Bob, from your perspective, what are the things you see where people shoot themselves in the foot?
Yeah, they come in and go, look, banker, we have a great story here. We need a creative banker who can really, know how to deal with a unique situation. Well, a banker hears that and they go, okay, we have issues. Most of these bankers that you're going to see, they're salespeople. They're trained salespeople. Some of them have credit backgrounds, some of them don't. They're going to see through a sales pitch on the front end. That's one thing. Another thing is, like what Rich says, not being prepared. The banker starts firing questions at you about, well, tell me about your last 3 years of sales, and how are you doing on cash flow or this or that, and not having an answer for it. Or coming in and thinking that the SBA is only for businesses that are not performing, that are in trouble and are an easy way to get a loan, or that the SBA is for D-minus companies. So they go in totally uninformed, totally unprepared, and it's just, you know, the banker can see through that.
Okay, we've got another question here, and that is, what's the main, you mentioned the COVID-19 needing to have a plan or at least address the issue. What is the main thing banks are going to want to see in that COVID-19 end of year plan?
Rich, you want me to address that?
Sure, and then I'll come in right behind you and show everybody how smart you are.
Yeah, I mean, there's not one thing. You're going to have to address from March how COVID affected your business down to a granular level, almost on a weekly, bi-weekly basis, comparing that to last year, so you can really prove that it did affect you substantially. If that's the case, you're going to have to show how you have been able to pivot, if you are pivoting, to either diversify your business structure to get sales from elsewhere, or if you're staying in the market that you're in, that you've retooled your business plan to year end, you know, to take advantage of any opportunities you may see, or if you're having to pare down, it's going to be a short-term COVID business plan at its smallest level. It's not going to be one or two things. They're going to want to see a lot.
So what you're also going to want to see as a banker is that I made smart choices. I made decisive choices. I did what I had to do to get through it because I'm a survivor. And some of those choices were difficult. And it may have to do with cutting salaries. It may have to do with you taking less salaries. It may have to do with how you've handled your accounts payable. What kind of deals did you make in terms of accounts receivable? And what are you doing or have you done to bounce back? Because in many cases, businesses have been able to pivot. Businesses have profited by the virus because of what they were selling or how they shifted. Yet in some cases, the virus just took you out. And that's understandable. But what did you do to show your stuff as a survivor so that you can come back? Did you take PPP money? Or have you been forgiven from that PPP money? Did you go for an EIDL loan? And if you did, they won't hold that against you. You did what you had to do to survive, and that doesn't count against you in the rest of whether or not they'll accept you for a loan. But it's the choices you made and how you demonstrate that you are a survivor and you adapted to the market, the good, the bad, and the ugly. If you're a farmer and you're a potato farmer and there's a drought, that's not your fault. But you're in it for the long haul, and how are you going to come back the next year? So I think that's the important thing, to show your chutzpah there and show it in a pragmatic way that would give a banker comfort. I'm not talking about I'm not talking about blue sky. Bob, I know I might have gone over to the blue sky world. Bring us back.
Yeah, facts, facts, and facts. Take out the flowery language, take out the pictures. The bankers don't care about that. They want to know three things, and those are: how am I getting repaid, how am I getting repaid, and how am I getting repaid. Charts and graphs are great, and by the way, Rich does excel at that. That's one reason we're together. But at the end of the day, they want to know how this loan is going to be repaid and what happens if it's not.
All right, guys, thank you for that. This ought to be a good question right here. If you had to narrow it down to one main piece of advice for a business applying for capital, what would it be?
I'll start that. Do your homework. Know what the bank wants. Know how to highlight what you do extremely well and mitigate where you have challenges and shop for the right bank. The other thing I would say is go to a bank first that you think won't do your deal, that doesn't like you. Let them beat you up, and then you'll be prepared for the next bank. Bob?
All right. To me, I mean, that pretty much says it all. I mean, I don't really have anything to add to that.
All right.
Okay, gentlemen. Well, it's about, we're getting close to wrapping things up here. As you can see on your screen, we've got an email address for you. We will have in September available a do-it-yourself template for loan package. Rich, would you like to talk about that just a tiny bit as we're closing out here?
I sure would, since I'm the salesman. We have put together an extensive template on everything you need, from executive summary, purpose of the loan, company section, milestones, industry section, sales and marketing, exhibits. And if you follow our template, you can put it together yourself. For right now, once that template goes up, it'll be free. We may change that. And then there'll be another vehicle where you get the template, we give you training, we hold your hand, and you write the package. And then there is our white glove treatment, where we write the package with you collaboratively. We make sure you have all your financial ducks in a row. We help you find the right banks and take the deal home. So look for that template. Ask for us to send it to you. Andrea worked with me, and then Bob worked with me to put this together. We're really proud. And Andrea, I'm going to just ask you to share for a minute what you think the template does for anybody looking to put together the right package.
What I think it does is, and anyone who's been listening for the last hour is starting to realize, if they didn't already, that this is an incredibly complicated process if you want to do it well. And if you want to get funded, you have to do it well. And the template really kind of, it gives you that, not only that, where do I start? You've got a place to start, but it walks you through, it breaks it up into manageable chunks, because looking at this just as a whole can be very daunting. And this template is a good way to take your time and break it into those little bites that are more manageable and work on it yourself.
Thank you. I just want to add one other thing. What we talked about today wasn't sexy, but I'll tell you what is sexy. Having the capital to grow your company and to sustain that growth. So you owe it to your business to become an expert at this, to get the capital wherever you need it as you grow. Very rarely can a high growth company grow on its own cash flow. This is all part of what you need to be able to do to be the best CEO and leader, and the ability to take that vision into reality.
Fantastic. Gentlemen, I want to thank you for your time today and your expertise. And I would also like to thank our attendees for their time. As a quick reminder, We did record this and it will be available. We'll send you an email with a link. In addition, on the Capital Masters website, thecapitalmasters.com, we've got some more resources. We have some training resources. We also help with the funding assistance. We have a blog that covers some really interesting topics that can help you out with this issue and others. So again, thank you so much for your time. We hope this was helpful, and thank you again.
Adios.
Thank you.